Hello, my name is David Hillier, and in this video I'm going to be talking about expected returns, variances and covariances, and I'll be showing you how to calculate these. This comes from my textbook, Corporate Finance, and I'll be covering sections 10.1 and 10.2 of the textbook. Now, why would you want to have an expected return or a variance or a covariance? Because as a financial manager, you're really interested in the cost of raising money. And you might be wanting to raise equity, that is, give up some ownership of your company, or you might want to raise debt, which is take a loan out or to issue a bond. Now, the cost to you of getting that financing is a return to the investor. So, whereas if you're saying, well, okay, it's going to cost you so much to raise money to issue equity, the investor, the provider of the funds, they'll be saying, how much return am I going to get? How much am I going to get from this investment? So, the cost to the manager is the return to the investor. So, one way of understanding how much it costs, how much you have to provide to investors, is by looking at this issue from the investor's perspective. And over the next few videos that I'll be doing, I'll be focusing on the markets. Now in chapter 9, I spend a lot of time on the markets, just looking at average returns, etc. And in actual fact, in many companies, the the cost of raising equity financing can be calculated just by taking a historical average return, which is what we did in an earlier video. But another way of doing it is to actually get a bit more theoretical, a bit more analytical, and saying, well, okay, are there models, are there drivers, are there determinants of returns? So, for example, you could say, well, okay, if you're operating in the mining sector, well, the mining sector, you see on a daily basis that mining stocks go up at the same time and they tend to go down at the same time. If you're in the financial services sector, the stocks tend to go up at the same time, go down at the same time. So we see an industry component there. And the way in which companies move up and down together, or maybe move in opposite direction, is known as their covariance or their correlation. And in this video, I'll be showing you how to calculate the correlation and the covariance. So we're looking at three things. Expected return, that is the return that you're going to expect over a certain period in the future. From an investor's perspective, that is the same as saying, well, okay, if I invest in a company, what return am I going to expect to get? You don't know what you're going to get, so it's not a guaranteed return, it's only an expected return because there's risk there. We'll be looking at variance and standard deviation. Variance is a measure of risk, and standard deviation is another measure of risk. It's just the square root of the variance. And then we'll have the relationships between the different assets, and that is known as the covariance and the correlation. So we're going to use a very simple example here. Now you might think, well, okay, this doesn't really reflect reality. It doesn't make sense. Well, in actual fact, it is actually quite close to reality, because if you're a financial manager or you're an investor, you don't know what's going to happen in the future. But you might have ideas. Well, okay, what will happen to the return on an investment if there is a depression, that is like a serious downturn in the economy? What happens? What would happen to the return if there was a recession? It's still a downturn, but it's not as bad as a depression. What would happen to the return? What return would I get in normal times? And in what return would I get in boom times? And so what you're doing is you're standing here today and looking forward and saying, well, okay, what would I expect to get if there was a depression in the economy? If there was a boom time in the economy? So this example here is actually quite, it's fairly realistic. It's the way that people think. And you've got two companies, and it's been set up so that uh, you're going to see, negative returns in super tech and when the market's going down. But with Slowpoke, it's slightly different. You're seeing positive returns when the market's going down. Now, There are many cases where many industries, if you think about debt collection industry, they tend to do better when the market's not doing too well. But there are also other cases as well where your cost base, your income streams are linked to commodities. So let's say you're an exporter of gold and gold cost goes up. So that's your income. So you tend to do well when the gold cost goes up. So one company, their cost base might go up, but your income stream goes up. So you get the benefit. And that means that the cash that would go to each company would be negatively related or negatively correlated. So we've got these four different scenarios: depression, recession, normal, and boom. We have two companies. And the first thing we're going to do is we're going to say, well, what is the expected return over each of the four states, each of the four scenarios for each company? Now, we're not saying that one state is more likely than the other. We're assuming that each state is equally likely. So that means that there's a weighting, a probability weighting of each state of 0.25 because there are four states. So each state has a 0.25 likelihood of occurring. But when you've got that equally weighted case, then it's just a simple average. If you want to calculate the expected return, you just take the average. Now, look, if you didn't have the same weights, let's say that the normal time was 70% chance of occurring, then basically you have the weight coefficients. That's like 1 over 4 times minus 0.2 plus 1 over 4 times 0.1 plus 1 over 4 times 0.3 plus 1 over 4 times 0.5. If you had a greater weighting on the boom time, then you would have to have a smaller weighting on the other states because the probabilities must add up to 1. So you could have, for example, 0.1 probability for a depression, 0.1 probability for a recession, 0.1 probability for a boom. Now add up those probabilities, 0.1 plus 0.1 plus 0.1, it comes to 0.3. So the probability of a normal event, a normal period, must be 0.7 because 0.3 plus 0.7 is equal to 1. So that's the only way that you deviate it. But in here, we've got equal probabilities of each state. And so it's just the average. And the average is 0.175, which is equal to 17.5%. So that's the expected return for an investor looking forward in Supertech. And you do the same thing for Slowpoke. Slowpoke, you just take the average, and you see that the expected return for Slowpoke is significantly lower than the expected return for Supertech. Now, is it a better investment? Is it a worse investment? Well, you don't know yet because you don't know how these securities correlate with each other. You don't know what the variance is. And there's also other characteristics like systematic risk that we'll cover in a future video that will impact upon whether we think this is a good investment or not. So we have the expected returns. We've got 17.5% for Supertech and we have 5.5% for Slowpoke. And remember those as I go through the video. We're now going to look at the variance of the return. Now, the variance is calculated in the same way as I calculated the variance before in earlier videos, but there is a difference here because we have four different scenarios. That is a population. You only have events in one of each of those four scenarios. That's depression, recession, normal, and boom. And you notice that the normal has disappeared here for some reason. I don't know why. So there are four. So that's a population because they're not a subsample. So since it's a population, the denominator for our formula has to be equal to the number of the different scenarios that we've got. So in this case, it would be 4. If you looked at the time series stuff that we did for the chapter 9 readings, that time series was a sample, and so it was t minus 1. So what we do is, but the formula is just the same. So what we do is we have to calculate the deviation from the expected return for each state. So given that the expected return is 17.5%, We subtract 17.5% from minus 0.2, or 20%, and that gives us a deviation of minus 37.5%. And we do that for each state. And then we square them. If you remember that we don't want upside cancelling out downsides, so by squaring, you're only getting positives, and that gives you a much better view of the variability of an asset. So we then add up the squared value of the deviations, and then we've got to divide it by 4. Okay, so if you see here, I've got 0.2675. We divide the 0.2675 by 4 because there are 4 different states, and that gives us a variance of 0.066875. The standard deviation is the square root of that. That's 0.2586. It gives us a standard deviation of 25.86%. So the expected return is 17.5%, the standard deviation is 25.86%. Now we do the exact same for Slowpoke, the exact same process. In this case, the expected return is only 5.5%. We've got these deviations here, and we go through the same formula. We've got 0.0529, that's just the sum of these, divided by 4, and we have a much smaller variance, and taking the square root of that, it gives us only a standard deviation of 11.5%. So Supertech is much riskier, but you're getting a much higher expected return. Slowpoke, less risky, but you get a lower expected return, and that makes theoretical sense, because why would you expect a lower return for a higher risk investment? It just wouldn't make sense. So that's variance, that's standard deviation. We've already showed you what expected return is. The next thing is covariance and correlation. Now, the covariance and correlation is ask a question, well, okay, how do the two assets vary with each other? So if they're above the mean, are they both above the mean at the same time? Are they both below the mean at the same time? That means they've got a high correlation, a high covariance. Or do we have a situation where if one's above the mean and the other's below the mean, and similar, then that would be a negative correlation or a negative covariance. So what we're doing is we're looking at how both assets relationship in each state of the economy changes depending on the actual state of the economy. So are they both above their mean? Are they both below the mean at the same time? Do we see them moving together? That's high correlation or positive correlation. Or do we see one above their mean in one state and the other one below their mean in the other state? And like this, well, that's negative correlation. The way we calculate the covariance and the correlation is, we calculate the covariance first, and it's done in the exact same way as the variance. And in actual fact, the variance is just the covariance of an asset with itself. So if you think about how we square the deviation in variance, with covariance we multiply the two series deviations together. And if you think about the variance being the covariance of an asset with itself, well, if you've got the two deviations, you multiply them together, then you square them because it's the same asset. But with covariance, you're multiplying the deviations of the two different assets together. And this is what we're doing here. So these are the deviations that you saw from a previous slide. We multiply them, and then we add them up, and then we divide by 4. So you can see in this these two securities, then we have a negative covariance. Now the correlation is just a standardized covariance, and we standardize the covariance by dividing the covariance by the product of the two standard deviations. And we do that here, and it shows that we've got a negative correlation. Now correlation can only range between -1 and +1, and in this case we've got a negative correlation of -0.1639. So it's negatively correlated. So that's a very quick run through of expected return, variance, standard deviation, covariance and correlation, and my future videos will go on to use these in the context of portfolios. Thank you very much.